Good afternoon. Thanks for being here with us today. We have Jeff Carbone and Cliff Hodge. They will be providing a market update this afternoon. We'll go ahead and get started in just a few moments.
All right, good afternoon, everyone. Happy Wednesday. Good afternoon, Cliff. Hope you're having a good day.
Hey, Jeff. Good to see you again.
Yeah. I trust everyone had a nice Memorial Day weekend, and as the summer starts, either school is out or fast approaching the end. I'm sure we're all thinking about what is summer going to look like. As more and more states are loosening the restrictions, and as a parent and as parents, I'm sure we're all looking towards the opportunity of maybe even more than our kids to getting out and about after nearly 90 days or 90 plus days and the shelter-in-place orders have been in place. The big question, and I'm sure many minds or all our minds, is what will summer look like? Summer camps for many have been canceled. Travel plans changed. There's a tug of war between kind of normalcy and safety for our families, communities, as we continue to deal with the virus. We're also seeing that tug of war between the risk and returns of the market versus the economic data that continues to come in. Most of the time, it does not make sense to take an undue risk when uncertainty is around or abound. Protection of your money has become paramount in our minds. So Cliff, let's dive into the markets today and get a view of what you're seeing out there.
Yeah, thanks, Jeff. And let me make sure the screen share works before you do it here. We good?
We're good. You're good.
All right, good deal. Yeah, so we'll dive in with the view of markets over various time horizons. Obviously, we've had a pretty strong rally here the past few days, but really the last week with the S&P now down year to date only about 6.5% or so, down around 11 from the all-time highs in January. But still quite a bit of dispersion between the S&P 500, or really the top 5 names in the S&P, and the rest of the world. So as we can see, quite a bit of dispersion here on the U.S. Also from a sector perspective, you've got technology, communications, consumer discretionary, all either up or right near break even year to date versus industrials, financials, and energy, the more cyclical names, which have been leading here recently over the past 5 days or so. So seeing a bit of rotation, but equity markets have continued to go higher. So yesterday we broke through 3,000, which is the big round numbers are typically psychological resistance points. Broke down through that again going into the close, but then today actually closed at 3036 on the S&P, and also broke through the 200-day moving average, which is of interest to a lot of market participants, especially those who are more inclined to technical analysis. So even though we've rallied, I mean, it's all been based on multiple expansions, so based on optimism, based on hope. And as we'll see, I mean, the disconnect between the fundamentals and the economics, more importantly, continues to just widen out to even more extreme. So the valuation, the PE ratio on the S&P 500, again, at highest levels in 20 years, right? You have to go back to the dot-com bubble. But this week, I thought it would be interesting to look at it from a sector perspective, not just the broader S&P 500, but how do things look below the hood? We do a lot with sector analysis, and as you can see, there are really only a couple areas of the market that aren't, just outright expensive. So we've got the current forward PE ratio here in this column, the 10-year average, and then the delta, and for the more mathematically inclined, the Z-scores. So consumer discretionary, currently at 37 times next year's earnings, is a bit outrageous, over double the 10-year average. Industrials, even though they're still down, 15, 20% year to date, from a PE perspective, 50%. Similar with technology, the S&P 500, 40% over the 10-year average. So just the amount of frothiness and optimism in the equity markets really continues to confound, right? And we look at the earnings perspective here, and another example of just how out of the ordinary things have gotten over the past, call it 2 months, is if you look back on 20 years, the S&P 500 correlates to forward earnings estimates at a positive 0.9, meaning that these two data sets move almost in lockstep over long periods of time. But since the market top on March 23rd, the market bottom on March 23rd, the correlation has been turned upside down and flipped on its head. So 20 years, they move up a 0.9 correlation. The past month and a half, we'll call it 2 months now, down 0.9 correlation. So again, just a very strange market environment that we're in here now, in that nothing but optimism on vaccine, Fed pumping money into the system, V-shaped recovery. I mean, that's what's driving markets higher, and is completely at odds with really everything else that we track. And so, sticking with the earnings theme, estimates have come down for the year by about 21%. We did 161.5 last year. Estimates now for 126.5 this year. We think that's still high, but we look at 2021 numbers. We've pointed this out in the past, but this is almost a fantasy in our view, that not only are we going to fully recover, unemployment's going to go back down to the lows. I mean, we're coming off of tax cuts and everything else that we had in 2019. This goes to show that we think these estimates will continue to come down, which will drive even more of a wedge between the divergence in earnings and multiples. So we'll continue to monitor that as we move through. But last but not least, did just want to provide an update on Q1 earnings season, as we've essentially kind of come to the close. Sales up 1, earnings down nearly 8. Again, most of this is pre-virus. There's about 2 weeks worth of lockdowns built into the Q1 results. But again, that dichotomy, right? And this is why, again, we believe very strongly in active management. You've got strength in healthcare, technology, utilities, all positive earnings year over year, versus what we're seeing in those cyclical sectors, again, that have been beaten up. Financials, discretionary is the big bugaboo, at now 37 times earnings, just crazy. Down 24, and then materials down 19. So we certainly can sympathize and empathize with clients in that the past 2 months we've just had this screaming rally higher, and we certainly have not participated in 100% of the upside. But Jeff, as we review the markets and the data as it relates to the S&P and as it relates to other markets, it's just a bit of a head scratcher that we continue to go higher.
Yeah. Well, Cliff, you shared a lot of information there with the again, with some of the moving averages, as well as some of the PE ratios, valuations, et cetera, and that economic, the dislocation between the markets and the economic data continues. So And before we jump into the economy and the economic data, just a reminder for those that have been on the calls before, if you do have a question throughout, certainly at the bottom of the screen, just type in your question. We'll do a recap and answer questions at the end of the call. So Cliff, let's dive into that economic data and where we're seeing that dislocation.
Yep, absolutely, Jeff. So we'll start with the New York Fed Weekly Economic Index. Again, it's that high frequency data that comes in every week. We have gotten, for the first time, a bit of stabilization. Last week, we were down at negative 11.7. So we've got a little bit of a bounce here, or, we're not going down as fast anymore, which is a welcome sign. But again, within that broader context, just the amount of economic damage being done, I mean, this is still 2x plus what happened in 08, 09. So again, quite a bit of damage done in a short period of time. But, one of the data points that did come into the upside this week, which was certainly a positive sign, was that new home sales beat expectations by quite a bit. So the economists were predicting 480,000 new home sales for the monthly view, but actually came in quite a bit above at 623. So, while by and large the economic data is poor, there are certainly some green shoots that the market and investors are focusing in on here. But related to the housing market, and apologies that this is a little bit grainy coming through the presentation, this slide here shows the amount of mortgages in forbearance, right? So you contrast the relative strength in new home sales versus the amount of folks who, for whatever reason are not paying their mortgage. It's now over 8% of all mortgages in the U.S. are in forbearance. And that just means, again, you've made some sort of arrangement with a creditor to skip at least one payment without technically going into default. And part of this is because of the CARES Act. There were some allowances there, but still, I mean, the trend here inflecting a good bit higher going into a couple of weeks ago. This is as of May 10th. I believe this number is now actually closer to 9% of mortgages in forbearance, over 4 million folks. So if it's a temporary phenomenon and people are able to make that back up, I believe in July, this will trend lower and that will certainly be a good sign. But ultimately lenders and banks are going to have to be paid. And so if this does not trend down, I mean, that's certainly a significant risk, as we move through the summer and as these other provisions in the CARES Act begin to roll off that we'll continue to monitor. A couple of other data points of note and some economic releases. Consumer confidence came out for the month of May. Got a little bit of a bounce, a stabilization month over month. But again, if you look back the longer term, that coincides, the current level coincides with where we were right at the onset of the 2008 recession. So we got a little bit of a bounce there and then just cratered, right? So, we don't know that this is necessarily going to follow suit, but another example of again, the dichotomy between the real economic situation and the S&P, which has just thrown long-term correlations, out the window. So why does this matter? Again, that correlation between consumer confidence and the S&P 500 in orange, you can see it's quite strong going back even to 2008. We've got this huge divergence here opening up in May, especially as the S&P powers higher, but consumer confidence does not really participate in that same bounce. So either, one or two things is going to happen. Either A, confidence really inflects and hockey sticks back higher to catch up with equity markets, or the other scenario, which we think is higher probability at this point is that the equity markets catch back down to not only consumer confidence, earnings, valuations, and so on and so forth. You can kind of see the dominoes starting to line up here. And then quickly, before we hand it back, Jeff, just an update on the jobless claims numbers. So last week was 2.5 million. On a rate of change perspective, we're moving in the right direction, but the estimates for tomorrow's release are an additional 2 million new initial jobless claims for the week here, which would bring the total over the past 8 weeks is now at 40 million. So 40 million people have either lost their job or at least been furloughed over the past 8 weeks. Again, just pales in comparison to really anything that we've seen since the Depression. Continuing claims. Again, this is as if unfortunately people have to file a claim after they've filed initially if they have not been able to find a job. 25 million is that number where we are now. So just a lot of devastation in the jobs market. We're seeing that flow through into the confidence numbers, into the forbearance numbers with mortgages and delinquencies and things of that nature. So again, a huge disconnect that just continues to widen as we went higher again today, up 1.5% and 2% on the Dow.
It's certainly, I mean, the markets are making us scratch our heads because when you look at the data that you just went over, the unemployment numbers, nearly 40 million people unemployed, the loan forbearance on the rise, consumer confidence. When you look back at that chart where we're close to the highs earlier, just back in March, now falling back down. Those are not signs or indicative signs of a strong market. So let's kind of talk and move to where we are in our process and the positioning of the portfolios and the signs that we're looking at continue to follow right now, Cliff.
Yeah, and as as we alluded to earlier, or as you alluded to earlier, I mean, there's a time to prioritize preservation of capital, and then a time to get more aggressive and look to compound returns. And you still believe that we're in that capital preservation mode, and that's by and large how we're positioned. We still have elevated cash levels, have high tilts toward quality, some toward some growth. So we are still playing some offense, right? We're typically still getting half to more of the upside when we're having strong days. There are other days where we're not participating as much as we'd like, but really it's just the story of the S&P 500, the U.S. equity markets focusing on the FOMO, on the fear of missing out, while other markets and asset classes are not following along. So again, a quick review on the 10-year yield. We're actually down today. 68 basis points is where we closed. So again, we track yields because the bond market historically is a bit of a leading indicator for equities, and that embedded within the yield component are growth expectations and inflation expectations. So neither one of those are moving in concert with what's happening in the equity markets. High yield spreads have come in a little bit. So last week we were around 700 basis points. This week it's 675. So moving in the right direction here slightly, but still, again, at levels commensurate with where we were the last two recessions. So we need to see this continue to break down. Similar story here with investment grade credit. So pretty much right in line with where we were during the last cycle. So certainly not an all clear here on these fronts yet. The U.S. dollar, the dollar was up today, even though equity markets were higher. So again, still near these very high, very elevated levels. We need to see the dollar begin to break down, and the fact that it's remained so stubborn and so high, even though we've seen all this additional stimulus continues to reinforce our view that what's going on in the equity markets just continues to be this sharp, very sharp and very swift, but ultimately bear market bounce that is going to resolve to the downside here at some point. Similar deal with commodities. We got the bounce and are now kind of running into a bit of resistance here as the dollar is firmed up a bit. So we'll continue to track this. Oil is another one. We had a really strong bounce off the lows where we went negative briefly that day in what was that? Was that earlier this month or was that April? I feel like time is so compressed now in this environment, but running into up here and still, even though we've rallied a huge amount off the low, still over 50% below where we were even at the beginning of the year. Again, we'll continue to monitor this. I think we're at some pretty important levels, both in the commodity space, as we saw in oil, and then also in copper here as well, which seems to be running a little bit out of steam at these levels. And then last but not least, the volatility index, right? So volatility is also a leading indicator for equities. We were in this hyper volatile regime, but still staying stubbornly elevated between the low 30s, high 20s. Again, we want this to get down below 20 to be in a more normal environment. The long run average on the VIX is somewhere 15, 17 VIX. So still stubbornly remaining elevated and not giving us the all clear sign in equity markets to this point. Again, Jeff, before we hand it back off, can certainly empathize with the feelings of the FOMO out there on these big up days in equities. We still are by and large in that defense and capital preservation mode with some exposure to offense, right? So we still have that barbell strategy that we've been talking and writing about, but certainly more tilted toward defense. And we'll continue to do so as long as our process dictates that the signs just are not there yet. I guess the last thing I would say, before passing it off is that, if we are wrong, and this really is the start of a new multi-year bull market, does it make sense to abandon our process, chase at these all-time high valuation levels, and throw caution to the wind, or does it make sense to remain prudent, given that we anticipate having plenty of time and space and opportunity to reposition as the signals dictate? So, with that, I will hand it back to you, Jeff.
Thanks, Cliff. And we did have a question from Will, and maybe going back to the forbearance of the where we are right now, and he just wanted to ask if we know. If it's currently at 9%, do we know where it was during the financial crisis? And do you know where it was, Cliff, on that one? Or do we need to get back with Will and maybe?
Yeah, I'll need to get back there. It was more of a delinquency issue in 08, 09. So delinquency and then foreclosure. There was not the same forbearance agreements that were put in place for the CARES Act, but I can pull some charts on the delinquency and the disclosure and the foreclosures, but I don't have it right in front of me.
Yeah, I think that's a good point, Cliff, because with the CARES Act, there was definitely some means to kind of push off payments right now, given what's going on. So as you mentioned, it's not that it has to be paid. So things could change. But right now they've given, so if you miss the next 3 months, doesn't mean you're not going to pay that 3 months. It means that if you had 10 years and 3 months left on your mortgage, you now have 10 years and 6 months left on your mortgage. So it is not a forgiveness; it's a forbearance of the loan payments right now. So
Yeah, and that's for where people own. So there's also a very similar dynamic going on in the rental market as well, where, anecdotally, you hear stories about, we'll let you slide for the next 2 months, but then you got to double or triple up come July. I mean, there's, with the rental market, it's not quite apples to apples, because they're, it's more left up to the landlord versus the banks, which have a little bit more pressure on them from the federal government. But either way, I mean, these missed payments, forbearances, and things like that, I mean, they're typically leading indicators of delinquencies and then ultimately defaults. So we still think that there's a meaningful default cycle to come. Not only in the mortgage space, but credit cards, potentially student loans, you name it. I mean, there's certainly more pain to come there.
Yeah, thanks, Cliff, and thanks, Will, for the question. If there's any others, we've got a couple more minutes, but a couple things that just to kind of, I know there's been quite a few of you been on the calls before. I think a couple things we're looking at is probably given what's happening, maybe there's a little bit more of a calm within the market. We're dealing with COVID. We're back reopening America. So from these calls, we are looking at probably going to a bi-weekly call. So maybe those that are on, send us an email, let us know your thoughts if you prefer for us to stay on a weekly basis, or is it, would it be on a bi-weekly? Does that start to make sense? So we ask for your feedback on that, on just how much information should we be sending. Of course, we'll continue to do weekly commentary, but for these webinars, maybe go into a bi-weekly is where we're at. We're going to be looking at right now. So thanks for your feedback on that. Again, Cliff, the information you shared today is just a reminder for us all that this recession may be a little slower than anyone wants or anticipates. It's going to take time. We've seen Asia has got a little bit of a head start because they were dealing with the virus ahead of the U.S. But now in the United States, we have nearly 95% of the U.S. economies by GDP are in process of reopening, and we're continuing to keep our eyes on what that path looks like to the reopening. The recovery is going to be a function of elevated jobless and typical consumer behavior, which during most typical recessions is we pay down our debt and we look to increase our savings. We do not go out and spend all our dollars. Fiscal policy will remain in focus as policymakers continue to add additional tools to mitigate the headwinds. And as Cliff mentioned, the consumer confidence and confidence in general is a key as we all adjust to the changes COVID has brought to us all. You've heard us discuss in previous sessions that strong companies can and will become stronger, but weaker companies will also get weaker and weaker. And we saw it with Hertz just on Friday. So there will be a point that we can look upon this confidently together and see a stronger future with the markets. Whether a vaccine, treatment, or just the old good red, white, and blue American resilience kicks in, that may become their key driver. Cliff and I want to thank you for joining us for our call today. Of course, if there's any other questions, you can certainly feel free to send them in to Ashley or myself or Cliff. We'll be happy to answer them. Please feel free to reach out to your Cornerstone team. We appreciate working on your behalf. We hope you enjoy the rest of this shortened week, and be safe and healthy, everybody. Have a great rest of your week. Thanks for joining us.